Welcome to today's Q Master class on technical indicators and chart templates. Today is 2nd November 2021. I hope you can hear me. I'll continue. You have my detail already. Let's skip this slide. Disclaimer. I am not an investment advisor. This demonstration is for educational purposes only. It is not a trade recommendation. Trading involves risk. You and only you are solely responsible for the outcome of your trades. In the Q Master classes, we are going through all the Q components and underlying platforms one by one. Today, we are going to look at the technical indicators and charts. They are part of Q Elite and as well as Q Global. Q Elite runs on TradeStation. Q Global runs on MetaStock. Q Global versus Q Elite. What are some differences? Most of the Q chart signals are available in both Q Global and Q Elite, and they are displayed mostly in the same manner in terms of color, shape, style, etc. However, a few chart signals may be specific to only Q Global or Q Elite. For example, Q expected move is only available in Q Elite because MetaStock does not provide the necessary data yet. Another thing to note is that the underlying calculation logic is the same for Q Global and Q Elite. However, due to the differences in the underlying platforms, TradeStation and MetaStock, some of the indicators may be displayed differently, maybe not displayed on the same day. One example is headwind signal. It may not always appear exactly on the same day on the same stock on Q Global and Q Elite. Most of the time it does, but sometimes it may not. For practical trading purposes, these differences does not matter. You may use any of the systems, Q Global or Q Elite. Q Global, as the name suggests, can be used in global markets, any country, any exchange, any instrument. Q Elite can be used in the USA market in real time. Q Global is real time for all country, all exchange, all instrument. Q Elite can be used for USA market in real time, and it can also be used for other countries using MetaStock data feed, but that will be only end of day. Q Elite does not support real time for any country other than the US. Today is going to have probably a long day, many topics. In this session, we'll discuss individual Q chart signals, how they are combined into Q trade setups. That will be discussed separately. I'll take a separate session on that, on trade setups. Today's focus is individual chart signals, how to read them. Also, Q Global Explorer, Q Finder, that is part of Q Global, Q Elite Scans, and Q Elite Sonar. They are all used to find trades in real time or after the close, up to you. They are also not discussed in this webinar. They are discussed separately. Q Global Market Breadth, that is an addendum to Q Global, is not discussed in this session. And alternate momentum signals, which are the HJSI-like signals. They are not part of core Q Global and Q Elite. They are not covered in this session. So we are going to focus on the core Q chart signals, and that will also be a handful. We are going to look at the technical charts, the signals in them, the underlying platform and data, market country applicability, organization, convention. Then we'll spend a lot of time on individual signals. And lastly, we'll look at the chart templates that are created using the signals. I'll probably walk through the system along the way. We may not look at trading workflows today. I look at trading workflows or trade setups or both when I discuss the Q trade setups in a separate session. This session is for individual indicators and chart templates. Q&A is not only at the end of the session. You may ask question anytime. I'll keep an eye on the chat panel from time to time, and you may also use the audio if you would like to. Q technical charts. What are they? They are the core of all trading decisions. Each individual signal tells something distinct. Important, it is distinct. No two signals tell the same thing, and they tell something valuable. They may indicate a trend, overbought, oversold nature, stop level, etc. Every indicator tells something. Then multiple logically related signals or indicators are combined together to form a template. Each template has a specific use in trading. For example, deciding trade entry, setting stop loss for intraday trading, etc. So we have the individual signals and then grouping of the signals to create task-specific template. Q signals provide a complete set. They cover all facets of technical analysis, whether it is trend, range, exertion, etc., etc., etc. While it provides a complete set, I made an early decision about no redundancy. So no two signals represent the same technical analysis. For example, there is only one overbought, oversold indicator, that is stretch. Unlike traditional technical analysis where you may find many overbought, oversold indicators, and sometimes people use one, another time they use another, and sometimes they change parameters. I wanted to avoid that from the beginning. So it is a complete set. At the same time, no two indicators represent the same thing, no redundancy. You would probably use every Q indicator someday or other. In terms of design, all the indicators are designed to be visually distinct by design. I kept that as the underlying principle so that I don't have label on the signal. So I can look at pure charts, color-coded indicators, and I can decide what to do. You can decide what to do without the need for labels. When you start using Q charts, if you need, you may hover in case of Metastock or right click on a signal in case of TradeStation to see the indicator's name. After reading Q charts for a while, after using it, you won't need that anymore. Intentionally, I made the design so that we don't need labels on the indicators. Also, the indicators are intuitive, consistently color-coded. They are unambiguous from several angles, no parameters. Q signals have no parameter. They are designed to be auto-adjusting depending on the stock's moves. If we had parameters, like in traditional indicators or even in HSI, I see a lot of people have the tendency to use different parameters at different times. And certainly different people use different parameters for the same stock. That means when two people look at the same stock at the same time, they may come to different conclusions. I wanted to avoid that. That's why I made a conscious decision of not allowing to set any parameter in any indicators. On top of that, there is no threshold also. Not even any threshold checking requirement. If you are using traditional indicators, let's say RSI, stochastic, they have thresholds to be compared with. This was another conscious decision I made. There is no need to check threshold. So two people are not able to set different threshold criteria. Indicator levels are compared internally and the result is plotted on the chart as highlights. It may be plotted as a dot, as a change in color, etc. Whenever the threshold is hit, visually we come to know about that without the need to set any threshold. And therefore, the charts become unambiguous. Firstly, the indicators become unambiguous in itself, each of them. Two people will read the same indicator, come to the same conclusion. And because each chart template has logical grouping of indicators, this absence of any parameter, no threshold comparison, and consistent color coding means two people looking at the same indicator will always arrive at the same conclusion regarding whether it is bullish or bearish or neutral. That is irrespective of their trading experience and expertise. And when we use Q chart with other Q systems, Q chart is for technical analysis, the other systems, Edge for sector industry rotation, Vital for fundamental analysis, Index for market index analysis, Finder, Sonar for finding trades, Season for seasonality analysis. When we use them together, then we identify 360-degree trades easily where all the forces are aligned in our favor. Today, we'll focus on the technical analysis part, and that too on the individual indicators and the chart templates. Underlying platform and data, Q Global runs on Metastock real-time. If you are using Metastock real-time, then it uses Zenith data, which is 100% real-time. If you are busy during market hours, maybe you are in office and you cannot use real-time anyway, then you may also use daily chart if you don't want to or don't need real-time. Q Global runs on daily chart also. That uses the end of day data link data, usually for end of day analysis. However, for some major markets and exchanges, data link may provide hourly update on the daily bars. It will not provide hourly bars or 5-minute bars, but it may provide hourly update on the daily bars. That is a feature of Metastock data link. I think it is not useful for intraday trading. Even for end of day trade entry, I will not use data that is lagging by 1 hour. That is a long delay. But I mentioned it because Metastock data link has that option. I will say if you are only interested in end of day analysis, then you may use Metastock daily chart also. And if you want real-time analysis, you may use Q Global with Metastock real-time. That is for Q Global, that is able to do technical analysis in 100% real-time for all countries, all markets, all exchanges, including the USA. And Q Elite that runs on TradeStation, it has TradeStation real-time data feed for USA market. For non-USA market, you are able to use Q Elite using the Metastock data link data, but that will be only end of day. Though Q technical charts run on either real-time or end of day data, in practice, Most Q traders tend to use real-time version that enables trade decisions during the day without waiting for the close. Consequent benefit far outweighs the cost of the real-time feed in my experience. In fact, at present, every Q trader uses 100% real-time data, be it on Q Global or Q Elite. And also, I like this real-time feed avoids the need for cumbersome offline data management. No data is stored on our computer. Every chart is calculated in 100% real time. Which country and market? I will go through it quickly. Q Elite, USA market certainly, and global markets with end of day charts only using Metastock end of day data feed. Q Global, both USA and global markets 100% real time. Any country, any exchange of the world, and any trading instrument, stock, ETF, future, forex, index, etc. All can be analyzed technically using Q Global and Q Elite. Q technical charts, how they are organized. The charts are organized or grouped into templates. Templates are collection of related technical signals. Each template has a default interval or multiple intervals if it is a multi-chart template. For example, at a glance template has weekly and daily interval charts. You are able to change the default interval. However, usually you won't need that. Hardly ever Q traders change the default interval of the Q templates. A template is used for a specific task like trade setup confirmation. So we may scan for a setup using Finder, Sonar, etc. And we confirm the trade setup using a chart template like at a glance chart template. We may decide stop using a template. For intraday trading, there is another template. So each template has a specific trading task in mind. It is possible to combine Q signals to create new templates. Q Global, Q Elite come with default templates. It is possible to combine signals to create new templates, but again, usually not needed as ready-made Q templates cover every trading task. I can say that because I am trading using the systems regularly. So all the trading tasks that one trader usually needs, they are all covered by the ready-made Q templates. How to apply the templates? They may be applied using custom menu bar in case of Q Global or Metastock, or using hotkeys in case of Q Elite on TradeStation. In TradeStation, sometimes people may also create multiple workspaces or tabs in workspaces, each tab representing a chart template. Whether we are applying chart templates using menu bar or hotkeys or looking at multiple tabs or workspaces, they help us look at the stock from all possible angles very quickly and then arrive at a trading decision with confidence. We may use the primary chart templates first, and if we need additional information, we may look at the stock from other angles as well. The primary chart template for deciding trade entry is the at a glance chart template. Chart templates already have indicators plotted. Plotting an indicator manually is possible. Both TradeStation and Metastock allows that, but for Q systems, it is never needed nor advised. Many other systems ask people to plot indicators from insert indicator or somewhere similar to that from a drop-down sometimes. But Q system was designed so that people never need to draw any indicator manually. Everything that is plottable indicator and useful is already part of one or another template. and template has a specific trading task in mind. So for every trading task, every indicator that is required is already plotted. We just use the ready-made templates. You never need to plot an indicator manually to view it. So you don't need to ever plot it, then change color, change size, etc. Everything is done from the ready-made templates. Just apply the template. That also ensures that every trader looks at the Q indicators with same color, same shape, same thickness. Everything is same for everybody. So if we share charts, everybody knows what we are looking at without trying to read the labels. There is no label in Q charts anyway, or trying to right click and find out the indicators parameters. There are no parameters anyway. Don't even have to figure out the colors because the colors are all preset in the templates. That is not so in traditional indicators. For example, Dr. Elder's impulse system, some people use the color scheme green, red, yellow. Another person may use green, red, blue. Different people use different color schemes. It becomes confusing if we share the charts. I wanted to avoid that. So every indicator is pre-plotted with predefined color, shape, style. We look at the chart and we know exactly what it is. If an indicator is not part of any template, meaning if you look at the Q Global code or TradeStation Q Elite code, you may find some apparent indicators that are not in any template. But if you see any indicator like that, then it is used internally only. They are not meant to be plotted on a chart. So some people who are very technical, they may look at the internals of Q Global on Metastock and Q Elite on TradeStation and find there are other indicator being a generic name in this case. Those are not available on chart templates. And why they are not available? Because they are not supposed to be on chart templates. They are used internally. That means, once again, every indicator that we need is already in a chart template. We never have to look for an indicator plotted. We never have to set color. Everything is ready-made. Convention. Q signals are of two styles. Some signals are with a single color. They are usually represented by lines like direction lines, relative performance, etc. If it is a line indicator, then line tilting up means it is bullish. Line tilting down means it is bearish. If it is a line indicator, then it is a single color indicator, and the color itself may not say it is bullish or bearish. It's looking at the line tilting up or tilting down that we know the line indicator is bullish or bearish. And then there is another group of indicators where they change colors from day to day, week to week. They have range of colors, and if we have any indicator like that, then they are not line indicators. They are represented by dots, cross, diamond, etc. And for all of them, cyan or green is bullish or on the higher side or support. So all have bullish connotations. If the color scheme has cyan, green both, then cyan is usually more bullish than green. On the opposite end, magenta or red is bearish or on the lower side or resistance, all bearish connotations. If magenta, red both are present, then magenta is usually more bearish than red. And yellow is neutral or in the middle. So these are two categories. One is line indicators that don't change color and non-line indicators that change colors. And then we have pivots, price levels. Pivots are not dots, they are not crosses, not diamonds, not isolated signals like dot, cross, diamond. They are continuous signals similar to lines, but they are not, I mean, they are straight lines, pivot lines. When a template has multiple pivots, they are horizontal price levels. They are colored distinctly so that we know without any need of a label what that pivot represents. For example, in the intraday fine-tune chart, early range, high, low, previous day's close, previous day's high, they are all part of the fine-tune or precise entry chart. They are colored differently so that we know which pivot, intraday pivot in this case, is which one. And the same is true for quarterly and yearly pivots on long-term pivot chart. So we have two kinds of pivots. One is intraday pivots on intraday charts, and then long-term pivots on quarterly, yearly interval on long-term pivot chart. For both of those categories of pivots, the pivots have different colors. So we know from the color which pivot is what. So three kinds of indicators drawn. One is line, they don't change color. One is isolated dots, cross, diamonds, they change color. And then pivots, they also don't change color, but they are not line indicators in the sense they are always horizontal price levels. The line indicators are not horizontal price levels, they are going up, down, sideways. So we have these three classifications in terms of indicator styling. Now let's first list all the Q technical signals, part of technical charts. The technical signals may be grouped under different categories. And here I am listing the categories. First is the candle itself. That's a part of technical analysis. Then comes activity or volume. Then trend indicators like Q direction lines. When a stock is trending, it hits support and then resistance. We have memory trend line support resistance and watermark pivot support resistance. Now, they are important support resistances drawn from left and not redrawn based on recent price move, both for memory and watermark. This is a very important characteristic, drawn from the left and not redrawn based on recent price move, which makes them zero lag. So when price is there near the memory watermark resistance, we don't worry about lag. We can respond to price move instantly. Zero lag means that current price move or recent price move does not lead to redrawing or recalculation of the memory and watermark levels. The zero lag nature makes memory and watermark levels very powerful levels to enter or exit trades, which is not so for direction lines, for example, or moving averages or boundary lines. Those line indicators are redrawn based on recent price moves, but not so for memory and watermark levels. That's why these two levels are very important and powerful, because we don't worry about lags, we can make instant decisions. When we have support resistance, sometimes price can move in range between support resistance, and there are different ranges that can form. One is channel and the other is boundary. Channel ranges are straight line ranges. They are not trend line resistance support, but they are ranges created by price move, and boundaries are non-straight line boundaries, swing high, swing lows, between which price tends to move. So we have two different range indicators in terms of channel and then boundary. Then we have traders pivot, maybe for swing trading or for intraday trading. These are horizontal support resistance levels. Helps to see current price move in the context of the past price moves. So based on past price moves, different pivot levels are drawn. Can be intraday pivots like early range, previous day high, etc. Or it can be quarterly, yearly pivots based on longer term price moves. So these pivots help us to see current price move in the context of the previous price move. Next is momentum category of indicators, which are the traffic lights, flow, and backdrop. Traffic light and flow are momentum indicators on the daily chart, and backdrop is the momentum signal on the weekly interval. We didn't use same traffic light for weekly interval. We fine-tuned the backdrop for a longer term interval. Didn't just change the interval from daily to weekly and use traffic light for backdrop. Many systems do that, but we fine-tune the weekly momentum signal little bit better than just changing daily momentum signals interval to weekly. And you will see the difference if you watch a stock moving between different price levels in both weekly, daily, day after day. You will come to see the usefulness of having the weekly backdrop longer term, which is longer term, respond differently than the daily momentum, which is traffic light. Flow is a special day inside the traffic light momentum. These are momentum indicators. And as price moves up, down due to momentum, up, down, finally it becomes extended. And we have two extension indicators. One is pendulum or price extreme. Another is jump and thrust combined together. Two indicators, but usually we read them together. These indicators tell whether price is extended or not. Then we have intensity measuring indicators. They measure if price is intensely or volume or both moving intensely up or down. Usually they happen in bursts, not continuous, but bursts. We have two intensity indicators. One is pressure and U-turn. Pressure and U-turn. Usually we read them together, and then big move. Now, extension indicator tells if price is extended over longer period. For swing trading, we need a different kind of overbought, oversold indicator, and I mentioned it earlier. We have only one overbought, oversold indicator for swing trading, that is stretch indicator. If it is stretched to the upside, it is overbought, stretched to the downside, oversold. Once the overbought, oversold condition goes away, then the stretch displays a stretch release. That is one of the reversal signals. Bullish release happens at the bottom, bearish release happens at the top. We have different reversal signals. One is stretch release, that is release from overbought, oversold condition. Then we have indecision signal, that is indecision at the top. Because it is at the top, it is classified as possible reversal. You may say possible reversal signal. Truly speaking, it is indecisive signal, but because Q indecision happens at the top, it is classified as reversal signal. I'll go through more detail on this later. Then we have Q reversal itself. That's a reversal candle, another kind of reversal. And lastly, the very unique headwind reversal that tries to anticipate an impending reversal in a stock, either up move or down move. Up move at trend low and in a downtrending stock, and down move in an uptrending stock. It tries to anticipate on daily interval, usually used on daily interval. That's the headwind signal. So we have four reversal indicators: stretch release, indecision, reversal candle, and then headwind. Then we have volatility based indicators. One is option volatility. On Q Global underlying platform Metastock, we don't have detailed option data yet, so it is simulated. Option volatility is plotted as an indicator, and the same volatility is used in a percentile calculation to plot the color of the candles, that is called uncertainty. So option volatility and a percentile calculation of that's the uncertainty. Then we have weekly expected move, again based on option volatility. And finally, volatility band and volatility squeeze. Now the last one, volatility band and volatility squeeze, is based on the stock's volatility. It does not need option data, whereas the option volatility, uncertainty, and expected move, they need option data. So they may be simulated or they may not be available on Q Global. Option volatility is simulated, uncertainty is simulated in Q Global, and expected move is not there in Q Global. All of them are there in Q Elite. That's TradeStation based, and TradeStation is of course a brokerage which provides detailed option data. And volatility band and volatility squeeze, they are based on volatility but not based on option pricing, so they are available both on Q Global, Q Elite. Then we have another class of indicator, that is relative performance, that measures performance of a stock relative to the benchmark. Then yet another class to decide stop loss, that is the Q protection signal. Now let's go through all these indicators one by one. Candle. Candle charts clearly show the bullish or bearish move of that day. If we are using on intraday interval, for that interval, usually we are discussing swing trades. So let's focus on the daily charts. Candle charts clearly show bullish and bearish move of that day, usually of that day. Candle shape is an essential component of all the Q trade setups. If you see the Q trade checklists, candle shape is a component of, I think, all the Q trade setups. Do not buy on a bearish shape candle, do not short on a bullish shape candle. This is applicable to both swing trades as well as intraday trades. That's how we use the candle shape. Now, in traditional methods, there are many candlestick patterns. However, Q systems didn't try to define those because everything can be simplified to the following. Hollow candle is bullish, solid is bearish. Lower tail is bullish, upper tail is bearish. If we remember these two lines, then we can decipher every candlestick pattern from them. So we may decipher all commonly known candle patterns from the above four components. So hollow candle with small upper and lower tail. Hollow is bullish, upper tail small, so they don't have any connotation. So hollow candle, small upper tail, small lower tail is bullish. Long hollow followed by long solid. So bullish candle immediately followed by bearish candle, that is bearish. In fact, if you plot the chart with a 2-day interval, it will show as a candle with long upper tail. And we know long upper tail is bearish. So 2-day pattern, some people may say railroad pattern going up immediately coming down, that in fact is an upper tail candle on 2-day interval. So that's a bearish candle or bearish formation. Long upper tail as well as lower tail, that is indecisive, because long upper tail bearish, long lower tail bullish, so together they become indecisive. Long upper tail with small body, that is bullish. Long upper tail with small body, that should be bearish. This is a typing error. Long upper tail with small body is bearish, upper tail is bearish. Now, long upper tail, small body, followed by long lower tail, small body, that is indecisive. Again, on a 2-day interval candle, it will show as a candle with upper as well as lower tail. So if we just keep these two lines in mind, we are able to read all traditional candle patterns. Other than this rule that we don't buy on a bearish shape candle, don't short on a bullish shape candle, there are other ways we may use the candle patterns. A bullish candle after an indecisive candle may be a time to look for buy, especially at swing low. Not if the price is already moving up, then we may not have a low risk entry point, but a bullish candle after an indecisive candle, meaning bulls and bears are indecisive where to go, and then bulls to control, and especially at a swing low, bulls to control, that is a point to look for buy. Similarly, a bearish candle after an indecisive candle may be a time to look for short, more so at swing high. That's how we use the candles. Let's look at some candle charts. I'm not trying to look for trades. I'm reading the charts with specific indicators. This is a chart of candle patterns. Let's look at the numbers one by one. This candle, number 1, it has a long hollow body bullish, lower tail bullish. So this candle is bullish. This is bullish, number 1. Number 2, it has long lower tail, but also upper tail, which is not insignificant when we compare that with the body. So we will say it is indecisive, of course, more bullish than bearish, but looking at the relative sizes of upper tail and body, we'll still say it is indecisive. Meaning what? Meaning we are not going to take a trade at the close of this indecisive candle. We may be ready to take the trade next day, but we will not take an entry on this day itself. On the other hand, on point number 1, that is a bullish shape candle. No doubt about it. So if we have a trade setup, we don't mind taking a trade at the close of the day. And on this indecisive candle, number 2, if we didn't take a trade, the next day, we had a very clear bullish shape candle, hollow body. Hollow body is bullish, long hollow body is quite bullish. It had a gap up also. So we would delay our entry on an indecision candle and take the trade on the next day. At the top, if we see number 4, that is an indecisive shape again, with upper tail, with lower tail both. So that is indecisive. We are not going to take a trade. It is at swing high. And then we see a bearish shape candle here. So if we were ready by looking at the indecisive at the top candle, here we are not talking about Q indecision, just Q, not Q indecision, just indecision shape candles. Q indecision is different. I'll cover that later. So after indecisive candle, if we are getting ready to short, then we have a bearish shape candle. And if you see the other candles, this number 5 is the first bearish shape candle after the indecision at the top candle. So if at all we are going to short, we would not short all these days, we would short on this day, provided a proper trade setup is there. That's how we read the candles, indecision, then non-bearish candles, and then finally a bearish candle. And after our entry, first possible entry point, next day was very bearish candle. Both are very bearish, in fact. The second one, why I say more bearish, because it is much bigger in length, down candle, and much bigger in length than the upper previous candle number 5. So number 6 is bearish, number 5 is bearish. 6 is more bearish because the candle length is much bigger. Number 7 now. This is also indecisive. The lower tail is much longer than upper tail, but still the upper tail is significant relative to the body. We look at the candles and the bodies in relation to each other because it has both upper and lower tails. We may say it is more bullish than bearish, but we'll still say it is indecisive. That means we are not going to take any long trade on this day. Number 8, here also we have an indecision candle. Long upper tail, long lower tail. Next day, long body. There is upper tail, lower tail, but relative to the body, it is smaller. They are smaller. So this is a bullish shape candle. We could buy on this candle, or we could wait. If we wanted to wait, looking at the upper tail, we could wait, and next day then we would have a very clear bullish candle without any upper tail, almost no upper tail. Lower tail is bullish, hollow body is bullish. So we could get ready looking at the indecision at the bottom, enter the next day, or wait one more day to get a fully bullish candle. And here, point number 11, here I mentioned the case I told earlier, bullish candle immediately followed by a bearish candle. That is bearish. On a 2-day interval chart, it will show up as a candle with upper tail and solid body. So these two candles are bearish when taken together. So like this, when you read the candle charts, you will notice that often at swing highs, you will have indecision candles. If you combine the two candles together, either you will have indecision or reversal. So in this case, reversal. In this case, indecision. In this case, indecision, indecision. If you here combine the bearish, somewhat bullish, bearish, somewhat bullish, then bullish, all of them, if you take together, it is also showing reversal. Then here we see indecision followed by bullish. This kind of pattern forms all the time in daily interval and also on, let's say, 30-minute interval, 10-minute interval, 5-minute interval. And that is why we keep an eye on the candle shapes to see whether we are going to get ready for a trade. The actual trade setups are based on checklists. We have unambiguous checklists, but the candle shapes are important component of all the checklists. We never buy on a bearish candle shape, never short on a bullish candle shape, and we can anticipate a move when we study the candles one after another. After the candle, which is representing price move, let's look at activity or volume. We don't look at absolute numbers. We don't have any threshold, any parameter like that. Activity represents volume of an instrument. If you are using Q Global, even for Forex, which does not usually have volume associated with it, activity is plotted on Forex on Q Global. Why? Because Q Global's data is coming from Refinitiv, and Refinitiv is actually used by professional Forex traders, large banks, very large investment banks. They use, many of them, hundreds of them in fact, use Refinitiv as a platform to place trades. Not all the Forex trades of the world can be tracked by Refinitiv, and there is no exchange for Forex, but Refinitiv is somewhat representative, you may say, because a large number of large banks use Refinitiv for placing their Forex trades. So volume or activity, because in Forex there is no volume, I called it activity. For stocks, it is volume, is available on all the Q charts. Studying activity, just like I showed candle charts, studying activity also from one day to the next day provide valuable insight. Not probably as valuable as price move itself. So price move is the king, activity may be the queen, or maybe price move, I should be careful. Price move may be the queen and volume may be the king. what I meant is not to say queen or queen is superior. It's just that we use price first and then we look at volume or activity. In queue systems, we don't need to read the actual volume number. Color-coded bars, volume or activities represented by bars or histogram, thickness of the bars, extreme levels with dots tell everything that is needed. Bullish activity day is green bar. It is an up day. Up day relative to previous day, not up day from the open. From where do I read up day from open to close? I read that from the candle. From where do I read up day relative to previous day? I read that from activity bar color. If it is green bar, it is up day relative to previous day's close. Bearish activity day is red bar relative to previous day's close. High activity, not very, but high activity is shown by thick bar. High activity means above average activity. If activity or volume is high, that supports a trade in the bars direction. What is the bars direction? Green means bullish, red means bearish. Low activity bars are thin bars, especially for breakouts. If the breakouts are happening with low activity, thin bars, be it green or red, upside breakout or downside breakout, breakouts with thin activity may be avoided. Thin bars may be avoided. Exception is breakout with high pressure. We have an intensity calculation, that is pressure. If pressure is there, then even if activity is not heavy, it is okay to take a breakout trade. That's the value of pressure. Pressure combines price move and volume together. In general, though, low activity breakouts we avoid, except if we have bullish pressure. Then we term something as stair step. If successive activity bars are going up, maybe they are not above average, they are certainly maybe not extreme high, very high, but activity is going up gradually. It is like a stair step going up one day, the next day, the next day. That means interest is increasing in the prevailing direction. So we don't use it as a trade checklist, but the more we go through charts, keep an eye on these indicators, how to read them, how to read the formations, we get an idea whether more buyers are coming in or not. So stair step is something we keep an eye on. The other is skyscraper, which is nothing but very or extreme high activity. Together I may call it heavy activity. Heavy means either very high or extreme high. Very high activity will have green dot, extreme high cyan dot. We don't need to look very much whether it is cyan or green. So long as we have a dot, it is heavy activity and it supports a trade in the direction of the activity bar color. Breakout trades you may take only if they have heavy activity, very or extreme high, or you could look for pressure. So breakouts, we are always looking for heavy activity. We are not looking for heavy activity for trend following, go with flow trades. That is not a required condition for trend following trade, but it is a required condition if you are taking breakout trades. Also, the sideways market box and exhaustion-based reversal trade setups, they use skyscraper, heavy activity, very or extreme high in the checklists. They are part of the checklist conditions. Breakout trade setup does not have a checklist, but I avoid taking breakouts without heavy activity. And box bound setups, they already have heavy activity as a part of their checklist. The other formation we read is clustering. That is a number of nearby multiple skyscrapers or heavy activity bars together. One skyscraper itself is bullish. High activity bar is also bullish if it is green, of course. Red is bearish. And when cluster of them come together, we are calling that clustering, then it is even more bullish. It is even more bullish, but be careful not to chase a stock after it has displayed clustering of activity skyscrapers. If it has already displayed clustering of skyscrapers, it is bit too late to enter a trade. Stop will be far away. Now let's look at some activity examples. I'll again read the numbers one by one from starting from number 1. Number 1, low activity bars. Low activity bars are thin bars and red color. In this case, number 1 happens to be red, so that was a down day. Then number 2 is low activity bar, thin bar. Green means it was up day. Up day, down day, here relative to previous day's close. Then high bullish activity is thick bar, which is above the average level. So this is a bullish high activity. And then red thick bar, bearish high activity. Then we have skyscraper, heavy bullish activity, that is very or extreme high, green or cyan. We don't have to try to read whether it is green or cyan. So long as we have a dot, we know it is a skyscraper or heavy bullish activity. Green is bullish. And this is a skyscraper, heavy bearish activity. Magenta, sorry. Here the dot is not magenta or red, dot is always cyan or green. Dot is always cyan or green, but the color of the bar itself is red, that is bearish day, and extreme high is dot, extreme or very high. So it is a skyscraper bearish. There is no magenta dot, that is a typing mistake. And this is the average activity line. Whenever activity goes above the average activity, it is plotted as thick. Anything below average activity is plotted as thin. So we have thickness of the lines telling us something, above average, below average, that is low activity or high activity. Then we have color telling whether it is bullish or bearish. Then we have dots telling it is extreme high or very high. And here we have clustering, multiple, very, in this case bullish, very high and high activity coming together. And this is an example of stair stepping where volume is gradually going up. It's still below average, that's fine, but it is gradually going up. So here we see stair stepping, here we see clustering, here also we see clustering. So sometimes if you see clustering, so many volume came in, high volume came in for successive days, means bulls were totally in control. Then you may not buy after the clustering is visible, already 3 bullish days, stop loss will be far away. Instead, wait for a pullback and then look for a buy setup. Usually these swing lows will give go through a long trade setup. This is in fact a chart of Tesla. That is how we read activity. So we have candle telling price move, telling us about price move, activity telling us about volume move, not only bar by bar, but patterns like clustering, stair stepping, skyscraper. And then we read the chart's trend that is indicated by direction lines. Direction lines represent trend. They are plotted as line indicators, and line indicators mean they don't change color. So tilting up is bullish, tilting down is bearish direction lines. There are multiple direction lines of varying speed. The fastest one is magenta, then cyan, then light blue, then yellow and white. And how I colored them, I tried to keep the color temperature in mind. Magenta is understood to be of higher color temperature. White, yellow, blue, lower color temperature. So the faster lines I colored with higher color temperature. So it's easy to remember. Magenta fastest, then cyan, then light blue, yellow, white. Probably not exactly scientific, but I tried to color it in a way that is easy to remember. Fast magenta, standard cyan, medium light blue, slow yellow, very slow white. We don't need to read price relative to every direction line every time. There are certain formations that are useful. We rely on them. And here I list the useful ones, the ones I regularly use. When multiple, at least 3, maybe 4, not 2, at least 3 or more direction lines come together and fan out, converge and then diverge, that provides additional support to a trade in the fan out direction. It can be bullish or bearish. So 3 or more direction lines coming together and diverging, right at that point, we may take a trade in the fan out direction. You may look for a Q trade setup like go with flow setup. Usually fan outs will give rise to a go with flow setup, long or short, usually. So we don't need to have a checklist for fan out. The necessary checklist conditions are already in go with flow. And if we have a fan out, that is additional advantage. However, be careful of fan outs or go with flow, apparent go with flow setups if the stock is in a prolonged sideways move, as mentioned below. If it is in a prolonged sideways move, it may seem like a fan out, but if it is prolonged sideways move, we avoid the fan out. What is a prolonged sideways move? If the slower direction lines, so we have 3 slow direction lines, medium, slow, very slow. Okay, 2 slow and 1 medium. If the slower direction lines, the medium, slow, very slow, light blue, yellow, white, they are more or less flat on the daily chart. And the faster, the magenta, cyan, these are faster lines. They keep going above and below the slower ones. That indicates prolonged sideways move, not short-term sideways move. It is prolonged sideways move. If it is in a prolonged sideways move, then you may look for box trade setup. You may look for trend following setup only after a breakout from that prolonged sideways move. And here I mentioned fan outs, be careful to check that it is not in a prolonged sideways move. It's a prolonged sideways move. Don't try to take the fan outs, wait for a breakout and then a go with flow setup that comes after that. And you may also look for a box setup when it is in a prolonged sideways move. So we read the direction lines, how price is moving relative to them, but not every direction line all the time is important. We look for fanning out, we look for prolonged sideways move. Then also we look at direction lines on weekly interval. Especially for longer term investing or position trading, maybe not required for swing trading, where the holding period is about 5 to 7 days. But for position trading, where holding period may be few weeks to few months, and certainly for longer term investing, you will see sometimes a stock finds weekly support at one of the direction lines. Let's call it boss direction line. Usually at the light blue or cyan lines, less often maybe at the magenta line. Magenta line will be fast, so those are very sharp up moves. Once they are gone, they are gone. If we find a stock which has support at weekly magenta direction line, they are moving very fast. Unless we are able to catch them early, it may be too late. Whereas the ones where weekly find support at light blue or cyan lines, they are still moving relatively slower, but still strong up move enough. When it comes down to this support boss direction lines, let's call it boss direction line, that is an useful signal. If the weekly hits such a support, look at daily for a valid trade setup, buy setup. And if such a support is broken, that may be an alert to close a trade. Again, this is more for position trading or longer term investing. The boss direction lines, the boss can be any of them, light blue or cyan more often, less often magenta. But if we find a boss direction line, we may keep an eye on how price is moving across them, around them. Now, of the slower direction lines, the white and yellow lines provide very important support. If price comes down to these levels from above, it's important, comes to these levels from above, then look for buy setup. Now, white direction line is slower. If price comes to white direction line, that means price has dropped significantly relative to its peak. Usually by the time price comes to white direction line from above, price has dropped significantly. Even if it stops there, you may not buy just because price has stopped there. Look for any of the Q trade setups on the daily chart. White direction line is used on the daily interval. Look for any Q trade setup on the daily chart, because price has dropped significantly. Usually price would have dropped significantly relative to recent high. A go with flow setup may not be applicable. Even a pullback setup may not be applicable. So we just don't look at daily chart. We have to probably try to find some support on the weekly interval also. May not take a trade just based on white direction line on daily. We may look for weekly support, which may be trend line memory support on weekly or watermark support in weekly. That's how we use the white direction line. And yellow direction line is more robust. Many more people use it for short term swing trading, position trading. The pullback setup is based on yellow direction line. And it actually has a trade setup. It can be scanned for. Pullback is a stock in an uptrend, pulling back to yellow direction line and going up with bullish signals. So this is actually a setup based on yellow direction line, and based on white direction line, we may take a trade, but just the white direction line support is not enough probably, because price would have come down significantly. You may also look for weekly support, whereas pullback can be taken more comfortably, which is based on yellow direction line, but price has to come down from above, not from below. Let's look at some chart examples now relative to direction lines. With respect to direction lines, I'll again read the numbering from number 1. Here I have a number of examples of fan out. Fan out is 3 or more direction lines. In point number 1, I have cyan, magenta, and light blue. 1, 2, 3 direction lines coming together and then going out. That is a fan out. Here also number 2, we have a fan out, 3 direction lines, same 3, magenta, cyan, light blue, converging and then diverging. Number 3 also fan out, the same 3 direction lines, magenta, cyan, light blue, converging and diverging. 3 fan outs. So every time we have a fan out and the stock is in an overall uptrend, we look for a buy setup. Most likely all these points would have given us go with flow long trade setup. Fan out is not a required condition, but if we have a go with flow with fan out and then we have another stock maybe in the same industry also go with flow setup but without fan out, we may favor the one with fan out because that has more direction line support behind the trades. And number 4, this is a place where this area, all the 5 direction lines, magenta, cyan, light blue, yellow, white, all of them are in an uptrend. just prior to that, in this area, if you see, magenta, cyan, they were in a downtrend, then light blue also became in a downtrend. Yellow was always in an uptrend, white was always in an uptrend. Right at this fan out, all the five came to an uptrend. So this was a vital moment. Not only did we have a fan out after this pullback, this was the first time when everything was in an uptrend, and most likely we had a go with flow long trade setup here. We might have a breakout setup here. We could take the breakout trade probably, but if we didn't take the breakout trade, we could take the next go with flow trade that would have come here. That was supported by fan out, plus the fact that all the 5 direction lines started to become uptrending at the same time after this pullback. Again, these are not checklist conditions for go with flow long setup, but as I mentioned, if I have go with flow, that's great. I take the trade. If I have go with flow with fan out, that is great. And now if I have a go with flow with fan out, and the first time all direction lines coming together in an uptrend, that's even better. And that would be in fact the lowest risk first time long opportunity in the stock. And I mentioned about pullback. The pullback setup in fact came on this day. That is a stock which was above the yellow direction line, stock in an uptrend, pullback to support, and then finding support at the yellow direction line with bullish shape candle. That is a pullback setup. We may scan for it. Now, when it comes to yellow line, it is usually already moving down with respect to cyan magenta lines and sometimes even light blue line, as in this case. So they are not same as go with flow setup. A go with flow setup would not come here because many direction lines were downtrending. Go with flow setup would have come here, 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 but not at a pullback setup. So pullback setup is also a trend following trade. Go with flow setup is also a trend following trade. However, go with flow means it is a stronger uptrend at the point of entering. That this is a stronger uptrend, stronger uptrend, stronger uptrend. Pullback is also uptrend, but relative to a longer term. For immediate term, it was coming down, pulling back. That's why it's called pullback. Pulling back and then starting to go up, whereas go with flow usually it didn't pull back that much. That's the difference. And we can read the direction lines and see the fan out, see the first time all the lines are coming together, and take the trades accordingly. I tend to take equal risk in each trade. However, there are traders, many traders and many successful traders who vary position sizing based on how they perceive the chart or perceive fundamentals, perceive industry, everything together. So if that is the case, I would say they would have bought a bigger position at this point. They probably would have added to the position at the next point, which is go with flow fan out, and then again another probably add on position taken in the third point, which was also in the proximity of a pullback. I don't know if there was a proper pullback setup, but it pulled back to yellow line and then went up, gave a go with flow setup somewhere here. So they would have added additional positions, they call add-on positions at the successive go with flow points, and take the major position at the initial go with flow, fan out, and all direction lines coming together point. That's how we read the price move and the direction lines to decide if there is a trade. And if you want to vary position sizing, you may decide where to take bigger position, where to take add-on position based on such moves as well. Direction lines. Now let's look at an example of prolonged sideways move here. The yellow line and the white lines, they are more or less flat. and the magenta line, cyan line going up above them, coming down below them, going up above them. So when that happens, usually it is prolonged sideways move. It is not like watermark box setup. It is usually prolonged. Now, box setup can also be prolonged, however, not necessarily, but when this pattern happens, that white, yellow lines are flat and magenta cyan lines are flip-flopping above and below that, that is always a prolonged sideways move. Usually, you may not take a directional trade when it is in a prolonged sideways move. Instead, look for a box setup, which would come at the lower edge, buy trade here and here, these 2 points. Point number 2, these 2 points, you may look for box long trade setup. And at the upper edges, you may look for a box short sideways setup. And then you will notice that sometime in the pattern, it will move out of the extended sideways range. And yes, there would have been watermark levels also. Watermarks can be drawn shorter term as well as longer term. And the prolonged, why it's called prolonged sideways move, because it is using the movement around white and yellow direction lines. Those are longer term direction lines. That's why it's prolonged sideways move. It may coincide with watermarks also. That's why we would have box trade setups at the upper and lower edges. Eventually, it will break out of the prolonged sideways move. Now, breakout, as was in this case, was sudden. So you would not try to buy, chase the stock. We'll wait for price to pull back. And in this case, it didn't pull back to the yellow direction line here. It came little bit down and went up. So I would expect a go with flow long trade setup here. Actually, this stock fired go with flow setup exactly on this day. I have all the stocks names, but I don't want to discuss the stocks names. We are focusing on the indicators in isolation, and I use the same analysis in every weekend market roundup. You will see how I did the charts, and you will also look at not only the essential checklist conditions. The more you look at the chart holistically, you will be able to anticipate a move. So in this case, breakout case, I wouldn't buy. I would wait for the stock to pull back, not a pullback setup. It did go to the yellow line, but it gave a go with flow setup. That's even better. Go with flow setups are stronger uptrend buys than pullback setups. More charts. Point number 1, this is a weekly chart, and I talked about boss direction line. In this weekly chart, since the fan out at point 1, here was a fan out where 3 direction lines came together, even in the weekly interval, and then they diverged. So this was a fan out at point 1. Since the fan out, every time price came to the light blue direction line, 3 times it happened, it found support there. So in this case, we'll say the boss direction line on the interval is the light blue line. And therefore, whenever price came to the boss direction line, we would switch to daily interval and look for a buy setup. At this point, the buy setup could be go with flow long setup. At this point, looking at the long lower tails, it could be go with flow as well as box long trade setup. So we would look for those trade setups on the daily interval when we see support in the weekly chart on one of the boss direction lines. Here, the light blue line provided support. Sometimes you will see the cyan line, and less often even the magenta line providing support. And what it means by support, it means it's going up, little bit coming down, going up, coming down, going up, coming down. It is never breaching which direction line, and that is in this case the light blue line. That's why we call it a boss direction line. That's how to use it. Again, it is more for position or longer term investment, position trading longer term, not for swing trading. We would not need boss direction lines for short term swing trading. The direction lines provide trend, but they are not zero lag indicators. And it is not necessary to have every indicator as zero lag. Lagging indicators like the direction lines are also useful. That's why we can have pullback setup, go with flow setup. But zero lag indicators are super useful in my experience. And I think your experience also if you're using the Q systems already. And support resistance memory lines are like that. Memory lines are auto smart support and resistance trend lines, not pivot lines, but they are trend lines, automatically drawn smart lines. Support lines are shown in green or cyan, resistance red or magenta. Memory lines can be drawn looking back few days to few years. Sometimes they may come from as far back as 10 years, and they are very powerful. Shorter term ones are also powerful, but the longer it becomes, you will see a price is dropping sharply. Then if you don't have memory lines, you will not know exactly why it stopped there. But if you have long-term memory lines, maybe even on the weekly interval, you will understand why price is stopping there. Exactly how they work is a mystery, but they, at least mystery to me, but they work very well. The way they are calculated is, I think, very unique. Not every trend line is useful, but the memory lines are automatically drawn and they are very smart, so they are pretty useful. The memory trend lines are so effective that we never trade against it. Instead, try to take advantage of it. How not to trade against it? Avoid buying when memory resistance is nearby. Instead, exit a long position when price comes to memory resistance. Similarly, avoid shorting when memory support is nearby. Instead, exit a short position when price comes to memory support. That means if a memory support is nearby, when we took the short trade, we already knew it. Why? Because memory lines are drawn from the left. They are not redrawn. So when we took the short trade, we already knew. If we took a short trade, we already knew memory support is there. And we assess the reward risk at the entry point itself. And if the memory support did not provide enough reward, we would not have taken the trade. So if we took a short trade, we knew a memory support is there. We already calculated that if price came there, our reward risk would be attractive. So we would exit the trade at trend line support. Similarly, if we bought a stock and we already knew memory resistance is there, we would have calculated that at memory resistance, is my reward risk attractive? And if it was attractive, only then I would have taken the trade and I would exit the trade when it hits trendline resistance. We will not buy near trendline resistance, we will not short near trendline support. Instead, exit a short at trendline support, exit a long at trendline resistance. That's how we don't trade against them, instead take advantage of them. More on memory lines. Bounce setup is a specific Q trade setup that is based on exhaustion and the memory support line. So it has to be exhausted, drop sharply, suddenly, then find support at memory support. That is a bounce setup. Sudden sharp drop associated with heavy activity, stopping at memory support, closing higher than previous day. That is a bounce long setup. And usually because price is dropping sharply, if the stock has options, option volatility is very high, you may look for short option strategies like short put if you're willing to short put, which I may do sometimes if I'm confident on the stock is fundamentally strong, and I am willing to hold it longer if need be, then I may use short put, or you may use also short put vertical. That is also a short option selling strategy. Then you are taking advantage not only of the price move in terms of bounce long setup, but also taking advantage of the elevated option prices by using short option or option selling strategies. Because the support resistance memory trend lines work, breaking of them is also significant. Look for a long trade if resistance memory breaks, and short trade if support memory breaks. And Q has a breakout trade setup. You may scan for it. Is there in Sonar? Is there in Finder? Is based on breaking of trend line support. So we have two trade setups using memory lines. One is bounce, that is finding support and then breaking of support, breakout setup. Sometimes price is inside both memory support and resistance. That indicates a range or triangle. Sometimes the triangle may be sharp. Sometimes it may be very gradually tapering triangle, but we just use a single term triangle so long as we have a resistance trend line which is in red or magenta, support trend line green or cyan, whether it is with a sharp angle triangle or not so sharp angle triangle, we just use the same term triangle. If it is inside a triangle, then look for reversal trades at the edges of the range of the triangle. Avoid taking such reversal trades if price is already near the tip of the triangle. So if our triangle is very tapering like this near the tip, we'll not try to take a reversal trade near the tip, but we may take reversal trade from the second case where we are not near the tip. Tip would be far into the future. So we may take reversal trades inside a triangle, but we will not take directional swing trades like go with flow trades inside the triangle. Instead, we may wait for a breakout. So we may take reversal trades or breakout trades, but we will not try to take go with flow trades inside the triangle. Now I mentioned avoid taking reversal trades if price is already near the tip of the triangle, but there is an exception. Exception is if the out of the triangle tip move is also breaking out of a Q squeeze with pressure. Because by definition of Q squeeze, volatility is very low, price is not moving much. So it may be, this Q squeeze I mentioned is based on stock's price volatility, not on option volatility. So stock's price is not moving much. It is possible it is near the tip of a triangle. And then if it is breaking out with pressure, then we don't mind taking the breakout if it is coming out of a squeeze. But if it is not coming out of a squeeze, then breakout from the tip you may avoid. Because by the time it comes to the tip of the triangle, the momentum is not very clear. We may wait to see the direction. Exception is when it is also moving out of Q squeeze with pressure. Again, Q squeeze and pressure, they are available in Q Sonar, Finder, etc. You may scan for trades that are giving these characteristics. In general, breaking out of a squeeze pattern with intensity or momentum signals is allowed, whether it is inside triangle or not. Breaking out of squeeze with momentum is always allowed. In fact, that is a pattern I often look for and many other traders look for. In that case, breaking out of squeeze with intensity or momentum, we don't need to look at the triangle. Avoid trading when price is near the middle of the triangle. That is a no trading zone. That is always true. We never trade right in the middle of a triangle. Now let's look at some charts with trend lines. This stock is inside a triangle. It has a resistance trend line, memory trend line. Resistance lines are drawn in red. In weekly chart, it will be drawn in magenta. This is a daily interval chart drawn in red, and trend line memory support drawn in green. It is inside the triangle. So we'll not try to take any trade at this level. We could look for a breakout to the upside because the last candle here is bullish. We look for a breakout to the upside. And if the breakout happens, we may look for a breakout setup. Now, looking at this pattern, if I don't have the squeeze indicators here, but if you see it was inside a squeeze and this last move was breakout of the squeeze with bullish momentum, then you may not wait for the trend line resistance of the triangle to be broken. You may take an early position on this day itself. This is what I mentioned earlier. Usually we don't like to trade inside the triangle, but if it is also coming out of squeeze with momentum, and momentum may be bullish pressure, it may be the alternate HSA like momentum signals, Kahuna, pocket pivot, etc., then you may take an early position. You may add to the position after the breakout, but I would not mind taking a position inside the triangle if it is also coming out of squeeze with momentum signals, pressure as well as HSL signals. The more momentum signals are there, the more easy the decision making will be. But if there is no squeeze, I want to repeat this part. If there is no breakout from squeeze, we never want to take a trade against the trend line support resistance. So we will not buy on this day because trend line resistance is very close. Let's see another chart. This was inside a very similar triangle pattern. And right yesterday, it broke out of the triangle with a very bullish shape candle. So this is what gave a Q breakout long trade setup yesterday. The stock is not important. So we had an example of a stock inside triangle, and we now see an example of how a breakout looks like. Breakout from trend line resistance, very powerful setup because the trend lines themselves are so powerful. A breakout from them, in this case I see very bullish shape candle. We already studied about candle shape, very bullish shape candle. Probably there were other momentum signals also. Then it would be a valid breakout setup yesterday. Let's see some more charts with trend lines. I mentioned about long-term trend lines. If you didn't have the memory trend lines, you might not know exactly why price is stopping at a particular level, like this level. But we have this very long-term memory trend line. And when price came here, and I can see it dropped sharply suddenly, came to the memory trend line support, stopped right there. And then it went up with a close higher than previous day's close. That is the textbook definition of a box long trade setup. And you could, as I mentioned, take advantage of high option volatility to short the put, or at least short put vertical. Another technique that you may use is short the put, or maybe to be on the safe side, take a short put vertical and then buy a call option. It's like a synthetic long stock position with a protective put, and you may book profit in the put very fast as price goes up. So in this case, when price came here, the short put taken at this point would lose a lot of value, and the long call taken at this point would gain a lot of value. In most such cases, it is possible to close the entire short put position, or if you are taking verticals, it is possible to close the entire short put vertical position and close some of the long calls and hold only a number of long calls that would be totally free by that time, because you have profit from short put vertical or naked put and you would have profit from long call. It is possible to close the entire put positions and some of the call positions to make the remaining calls totally free. So your cost basis is still, you already have some money in the account, and usually such strategies would be taken usually with 45 days to expiry, more than 1 month, let's say 45 days to expiry at least, and you may continue to hold the remaining call lots without any risk whatsoever. Now, will you let them go to zero if price comes down? Of course, no, because you already know the trend line supports. So if price is breaking below trend line support, you may decide to close the trade with some profit on the remaining call options also. Or if you think that it's already zero cost basis, you may just hold it for longer term. Now, I mentioned 45 days to expiry because I am focused more on swing trading on my own account. But if you are trading longer term, position trading, longer term investing, then instead of 45 days to expiry for such bounce trades using short put or short put vertical and long call combination, you may go for longer term expiry as well. So this was an example of a bounce long trade setup that came a few days earlier, and in this case the trend line support came from far away. This was still a daily interval, but sometimes you will find such long-term support coming even in the weekly interval, price coming to those supports and going up from there. Those are robust buy entry points. So these zero lag indicators, trend lines, are memory lines, and then we also have zero lag pivot lines. By the way, I don't think I will be able to complete the entire session on indicators and charts today. Maybe I'll go through watermark levels. Those are the zero lag levels, and then we may stop today. Let's look at watermark support resistance. They are high and low watermark levels. It is as if the price is moving up and down in waveform, and the significant, not all, but significant high-low watermark levels are drawn based on past peaks and troughs, only the significant peaks and troughs. Look at them to see if price is range bound. Such a range forms a box pattern on the chart with the watermark, pivot, support, resistance. Take a reversal trade at the edges of a box formed by watermarks. Q box setup relies on that. Avoid trading when price is near the middle of the watermark box, similar to triangle. The middle of the triangle is no trading zone. Middle of the box created by watermark is also no trading zone. Breakout from a box often means that price is already on the move for a while. So you may not have a low risk entry point when it is breaking out from a box, which is different from breakout from triangle. Breakout from triangle may sometimes give low risk entry point, not always, sometimes, but breakout from box almost never gives low risk entry point. It is difficult to find low risk entry points when box breakout happens. A lower risk entry would have been at the opposite edge of the box. So if we are thinking of long box breakout, instead of that, we might take a box long trade, not breakout, box long trade at the support edge of the box. That would be the Q approach. Sometimes you may find a box breakout with a gap up. Then it may give a low risk entry point, putting stop below the gap up candles low. So if it is a gap up, we may be able to trade breakout from box with low risk. But if it is not a gap up move, then breakout from box does not usually give low risk entry. Also, box breakout may be taken similar to triangle breakouts. If at all you are taking them as trade entry point, you may ensure there is enough momentum. And even then, always assess the risk. Usually it's difficult to find low risk trade entry point, but you may look at possibility of having a narrow risk. And if you are taking a breakout from box, I don't suggest, but if you are taking, look for a valid reason for a breakout, like a product announcement, new geography, earnings, drug approval, etc. The box was formed for a reason, and there needs to be a reason for the breakout. If no visible reason, and I can find out the reasons from Refinitiv. Usually when I want to know something about a stock, I go to Refinitiv. You all have Refinitiv if you are using QEdge Vital Index. So that's where I go to check for the reason for the breakout. If there is no reason, I may not take a box breakout because the risk could be too high without any reason for the breakout. As I mentioned, box breakout with gap is tradable. Then we may put stop just below the gap candles low. Q pressure provides momentum behind a box breakout trade. Box breakout without pressure, even if that has gap move, may be avoided. So any breakout in general, we need some extra force behind it. The force may be pressure, it may be heavy activity, or it may be the other momentum signals. Why I like to take breakouts, be triangle breakout or watermark breakout, if I take at all watermark breakouts, I like pressure because it combines price move along with volume. All the other momentum signals in alternate signals, also HSLI signals, they are, or most of them are not using volume at all, like Kahuna, Mobo breakout. They are not considering volume. Pocket pivot considers volume, but pocket pivot does not necessarily imply high enough volume. It just tells increasing volume in some way, but it does not talk about high enough volume, whereas pressure is very useful. Pressure comes only when there is high enough volume with high enough distance. So I like to take breakouts with high pressure or high activity. You could use either. If you are looking for box breakouts, you may look for stocks with pressure and or gap on Q scans and see if they're breaking out of box. Let's look at some box examples. This is a stock where we have watermark resistance, watermark support. So we look at the watermark support resistance to see if it is moving in a box or moving sideways, and which was true in this case. Then at point 1, it came to the watermark support and reversed. That actually gave a Q box long setup. That was at the upper, sorry, not upper, that was at the lower edge of the sideways move. And the opposite thing happened at the upper edge of the box. It reversed at the watermark resistance, and in this case, unlike at the bottom it didn't have a false downside breakout, but at the upper edge it had a false upside breakout. It tried to go above the watermark resistance, immediately reversed, and that gave a box setup with not necessary condition, but with the additional condition, additional confirmation of false breakout. False breakouts are even more powerful because many traders are breakout traders. They were lured in and immediately price fell down. So Q traders would carefully watch these areas, the box upper edge and box lower edge. And if you look at the candle patterns, you would see some indecision before the box setup came. And indecision not only in terms of candle shape, often indecision will come in terms of Q indecision signal. We'll study that signal also later. So here we see the watermarks creating a box, and then we have two box setups at the lower edge and upper edge. That's how we use the watermark signals. Let's see what indicators we covered. We looked at candle patterns, how price is moving day to day, and how we can combine multiple candles into a formation. That's price move. And then volume. Volume itself is important. We may study the bullish volume bar, bearish volume bar from color, high, low volume from thickness, and extreme high from the dots. In addition to individual volume bars, we can study the skyscrapers, especially skyscrapers, along with clustering. And we may also study the stair stepping. Then we looked at the direction lines, multiple direction lines, how price is moving along them. We don't have to read every direction line all the time, but some things may catch our attention automatically as we study the charts. One is fanning out, multiple trend lines coming together and diverging, at least three or more. That is one important formation. And on top of that, if we see a fan out where for the first time after a pullback, all the direction lines are in an uptrend, that probably is the first position taking point, the bigger position when people take multiple sizes at different points. So you could look for fan outs, and also the first time the fan out happens when all direction lines come together. You could look for Bosch direction line on the weekly interval, and then if that is holding support, you may look to daily to find a buy entry point. And we talked about extended prolonged sideways move when the white yellow lines are almost flat and magenta cyan lines are moving up down around them. That is an extended or prolonged sideways move. Unlike watermark box may be long term but maybe short term, and this is extended sideways move. We look for box setups at the edges of that extended sideways move, or we wait for the breakout and the subsequent go with flow trend for a long setup. That's how we use the trend lines. Then we looked at the zero lag indicators, support and resistance, memory and watermark. We look for buy setups from their support. So it will be a bounce setup for memory support and box setup for watermark support. For memory breakout, we look for breakout trade. For watermark breakout, you may look for a breakout trade, but be extra cautious because usually the stop loss is not nearby. Now we have many more indicators to cover. We'll start again next day. I'll schedule and announce the date to you shortly. Thanks a lot for joining. I look forward to seeing you in our next session. Keep safe, and as always, trade profitably. Thank you.